than 90% of retail traders lose all their capital invested in the Forex margin trading. Forex margin trading uses leverage from borrowed funds to make substantial amount of profit while the losses are imminent most of the time. Here's an in-depth and detailed look at these aspects, including specific practices and issues with Forex brokers, dealers, and market makers that you should be familiar with prior to engaging in Forex trading. First, types of Forex trading markets. Spot market. The spot market is where currencies are traded for immediate delivery. Transactions are typically settled immediately due to the intermediaries, such as the market makers and liquidity providers. The spot market is the most straightforward and liquid form of Forex trading. CFDs, contracts for difference. CFDs are derivative products that allow traders to speculate on price movements without owning the underlying asset. They offer leverage but also come with higher risks. CFDs can be used to trade various financial instruments, including currencies, commodities, and indices. Futures. Futures contracts are standardized agreements to buy or sell a currency at a predetermined price at a specific future date. They are traded on exchanges and provide leverage, but also carry the risk of significant losses due to market volatility. Options. Options give traders the right, but not the obligation, to buy or sell a currency at a specific price before a certain date. They offer flexibility and leverage, but can be complex and require a good understanding of market movements and timing. Second, exchanges that control prices. Precious metals. Prices for gold and silver are primarily determined on the London Bullion Market Association, LBMA, and the COMEX Commodity Exchange, a division of the New York Mercantile Exchange, NYMEX. Commodities. Commodities such as agricultural products, metals, and energy products are traded on various exchanges including the Chicago Mercantile Exchange, CME, Intercontinental Exchange, ICE, and the London Metal Exchange, LME. Oil. The price of oil is influenced by trading on the NYMEX for WTI crude and the ICE Futures Europe for Brent crude. Stocks. Stocks are traded on numerous exchanges worldwide, with the New York Stock Exchange, NYSE, and the NASDAQ being the most significant in the United States. Bonds. Bonds are traded on various platforms, with the Electronic Municipal Market Access, EMMA, and Trade Reporting and Compliance Engine, TRACE, being significant for municipal and corporate bonds in the U.S. ETFs. Exchange-traded funds are traded on stock exchanges, primarily the NYSE Arca and the NASDAQ. Mutual funds. Mutual funds are not traded on exchanges. They are bought and sold directly through the issuing fund company at the fund's net asset value, NAV. Third, virtual prices in CFD and spot markets. Definition of virtual prices. In the context of CFDs, contracts for difference, and spot markets, virtual prices refer to the quoted prices that traders see and trade on through their brokers. These prices are derived from the underlying market but are not directly transacted on traditional exchanges. CFD prices are generated by brokers and are based on the prices of the underlying assets, such as currencies, commodities, or indices. However, these prices can be influenced by the broker's pricing AI algorithms, spreads, and other factors. Spot market prices are the current market prices. These prices are influenced by real-time supply and demand, but can also be affected by the broker's AI algorithms, bots, spreads, and fees. Relation to actual prices on exchanges. The virtual prices in CFD and spot markets are closely related to the actual prices on real exchanges, such as the NYMEX for oil or the COMEX for gold. However, there can be slight discrepancies due to the broker's spreads, fees, and any market manipulation tactics they may employ. It is crucial for traders to understand that while these prices are derived from real market prices, they are not executed directly on those exchanges. 4. Trading strategies and market manipulation tactics. Understanding manipulation. A successful trading strategy in Forex often involves understanding the various ways market makers and large players manipulate prices. Recognizing these tactics can help traders avoid pitfalls and exploit opportunities. Short covering and long covering. Short covering involves buying back previously sold positions to close them, often leading to a temporary rise in prices. Long covering is the opposite, where traders sell their long positions, causing a temporary drop in prices. Spoofing? This involves placing large buy or sell orders to create a false impression of demand or supply, then canceling those orders before they can be executed. Decapitation. A strategy where large traders push the price down to trigger stop-loss orders, then buy at the lower prices. Fake outs. Creating false breakouts by pushing the price beyond a key level to trigger buy or sell orders, then reversing the price direction. Traders need to be vigilant and adaptive, recognizing these patterns and adjusting their strategies accordingly. This might involve using tighter stop losses, monitoring for unusual order book activity, and being cautious around key price levels. 5. Leverage ratio. A leverage can magnify both profits and losses. A small adverse market movement can lead to significant losses, potentially exceeding the initial investment. Margin calls. If the market moves against a trader's position, they may receive a margin call requiring them to deposit additional funds to maintain their position. Failure to meet this requirement can result in the liquidation of their position at a loss. 6. Complexity and volatility. Market volatility. Forex markets are highly volatile, influenced by geopolitical events, economic data, central bank policies, and market sentiment. This unpredictability can lead to sudden and substantial price swings. Complex instruments. Forex trading involves complex financial instruments and strategies that require a deep understanding of the market-making dynamics, advanced technical analysis analyzing price actions, and risk management. 7. Lack of exchanges and transparency. No central exchange. Unlike stocks, Forex trading doesn't occur on a centralized exchange. Trades happen over the counter, OTC, meaning transactions are conducted directly between parties, often through brokers or dealers. Opaque order books because there is no central exchange. The order books aren't transparent. Traders cannot see the full scope of buy and sell orders, making it difficult to gauge market depth and sentiment accurately. 8. Broker practices. B-book and A-book. Brokers using the A-book model pass clients' trades directly to the interbank market, earning money through spreads or commissions. In the B-book model, brokers take the opposite side of clients' trades, meaning they profit when the client loses. This can create conflicts of interest. Variable spreads. Forex brokers often advertise low spreads, but these can vary significantly depending on market conditions, liquidity, and the specific currency pair being traded. Spreads can widen during times of high volatility or low liquidity, increasing trading costs. Spoofing and price manipulation. Some market participants engage in spoofing, where they place large orders to create a false impression of market demand or supply, only to cancel them before execution. This can manipulate price actions and deceive other traders. 9. Hidden costs. Swap rates. Holding a position overnight can incur swap rates, which are interest charges or credits applied to open positions. These costs can accumulate, particularly for long-term positions. Commissions and fees besides spreads. Brokers may charge commissions on trades, as well as various other fees such as withdrawal fees, account maintenance fees, and inactivity fees. 10. Psychological stress. Emotional strain. The fast-paced nature of Forex trading can lead to significant emotional stress. Traders must manage fear, greed, and the psychological impact of rapid gains and losses. Discipline and patience. Successful trading requires strict discipline and patience, qualities that many traders struggle to maintain, leading to impulsive decisions and potential losses. 11. Regulatory and fraud risks. Forex markets are decentralized and operate globally, leading to varying levels of regulation. Some brokers operate in jurisdictions with lax regulatory oversight, increasing the risk of fraud and unethical practices. The Forex market has historically been a target for scams, including Ponzi schemes, fraudulent brokers, and misleading get-rich-quick trading systems. 12. Fake news and market manipulation. Fake news. The Forex market can be influenced by false or misleading news. Traders might react to fake news stories, leading to significant price movements based on misinformation. Market manipulation. In less regulated environments, there is a risk of market manipulation by large players or even brokers themselves. Techniques such as spoofing, stop hunting, and spreading fake news can adversely affect individual traders. 13. Negative expected value EV. Gambling-like outcomes. Excessive use of margin in Forex trading can resemble gambling due to the high risk and volatility. Traders often experience negative cash flow most of the time, with only brief periods in the positive zone. We have covered almost most of the areas where the retail traders are not aware of the key dynamics of the Forex market. Understanding these dynamics requires a lot of practice and years to fully understand how all of these factors play out. And even professional traders many times don't understand them or even ignore them, which can lead to substantial losses. This has been Paradox Cycle GF. Thank you for watching and see you in our next videos.